Hi, and welcome to the Cost of Carry podcast. My name is James Chi, and thank you for tuning in. Let's get started. In Australia, the domestic cash rate has been an important topic for the past couple of months, the reason being that it is now at a historic low of 0.25%. Now, one of the interesting things about this is that not only has it occurred in a period following a natural disaster, bushfire season, as well as coronavirus, but it's also emerged as a result of declining consumer spending. And whilst the government believes it has taken the right stance, and for the most part it has, it would be an interesting topic of conversation discussing how low they can actually go. Obviously at 0.25%, there's not much room before it gets down to 0%, and at that point the lenders are just lending out money at cost, at their own costs. What this means is that for lenders to remain competitive, they have to align their rates closer to what the cash rate is. But what this means is that not only do the borrowers get cheaper access to funds, but one must also question that what are borrowers paying for? Does that mean that lenders are charging their customers for their overheads? Does that mean that lenders are charging them for their facilities? There are always going to be overheads in running a business, and this makes total sense. However, how much of the rate actually relates to the cost of lending out the money, and how much of it relates to their margin or their profit? I think this would be, obviously, this isn't always something that's going to be discussed openly, and nor should it. I think in order for each lender to remain competitive, they need to keep that behind closed doors. However, I think in this era of disaster, unfortunately, there's going to have to be a little bit more transparency about what people are paying for. Also on the topic of lending is the issue of housing affordability in Australia. In this period of coronavirus, if people don't have jobs, how can they pay their rent or mortgage or save for a deposit if they need their savings to live off while they are looking for a job or are out of employment? And for a period of time, housing prices were at a median price of $1 million. And in recent times, with corona and bushfires, I don't believe that will continue, or that will return for a while, simply because no one is buying or selling anything as what they used to, and that has been shown in the decline in clearance rates, specifically in the Sydney and Melbourne markets. For other areas such as Brisbane and Adelaide and Perth, property prices have dropped somewhat significantly. I know there have been some reports of up to 20%, up to 30% in some cases, and that can be a bit of a worry if you are trying to repay a mortgage and you need to do an annual review. And in the annual review, because the value of the property has gone down, that the LVR goes up. So the ratio of the loan to the value of the property has increased as a result of the decline in the property price. And that can be a problem because when LVRs increase, so do interest rates. And so this will be a testing period for most homeowners as well as lenders, and how they want to restructure their books. Hopefully, of course, this coronavirus period doesn't last as long as some are saying, but we must be realistic and prepared, as well as prepared for the world welcoming 2021 with coronavirus. While that's more than 6 months away, I don't think that some people can afford to live off not only savings but also to maintain their current repayments in this type of environment. As I mentioned before, coronavirus on auction clearance rates. Will the property market ever return back to normal? That's something that is up for discussion at the moment. I know agencies around the world have had to adapt their business models. And I think this gives more testament to the need for technology and digital literacy in the workplace, especially in finance. I think the customer values having a digital experience where they don't have to leave their house, or they don't have to sign things with pen and paper. They can use a digital signature, or they can do a virtual tour of a house on their phones, or they can sign into work securely and still do their regular job. And I think the price of technology has come at a bit of an expense. Technology and digital convenience isn't cheap when it's considered an innovation. So for example, digital signatures have been tried for a while now, and it hasn't been made mainstream yet, simply because there are a few legal and regulatory hurdles to work within, and also requires a process change. Whether or not some people are prepared to pay for that cost of convenience and cost of efficiency, that's another question that consumers will need to answer very quickly, considering that the world is in a period of shutdown and people are starting to get nervous about whether or not they can continue working, or they can continue with their operations, which are based in the traditional means of physical contact, face-to-face meetings, pen and paper, things like that. If no one's out and about, how can this traditional model work? And stuff like that needs to be discussed sooner rather than later. That relates to the point of diversification. We can't just ignore the traditional means of activity. So we can't just ignore paper documents. We can't ignore face-to-face dealings when it comes to buying things like cars or hairdressing or retail and restaurants. I think this reflects a notion that if you want to take the client-broker relationship, for example, brokers need to be able to provide an experience to their customers that reflects this diversified need for accessibility as well as timeliness. And the only way that can really be achieved is through technology, because it's instantaneous. It can be sent straight to your phone or your computer. It doesn't require much literacy in that respect. Sometimes there are some instructions on how to digitally sign some documents, but for the most part, if you can receive your two-factor authentication code and use that to open up your loan documents, you're halfway there. And it only just becomes a matter of ticking boxes and applying digital signatures before saving it and sending it back. And by that same token, I think brokers also have an obligation to maintain their knowledge and readings of what's happening in the world when it comes to technology and digital innovation, especially when it comes to things like open banking and blockchain, because these things are only a matter of time before they become mainstream, and it results in being able to get access to your clients' bank statements and filtering them so that you can accurately determine living expenses, for example. And this is an important conversation to have early on in the process, because when it comes to setting the expectations of customers, the worst thing that can happen is they are unprepared, or they don't know what to expect. What having this conversation means is that they understand what they're getting involved in. They understand that you are an individual or a broker that is willing to provide a service that is both modernized as well as relevant to what the environment is. That may be showing that you want to do video calls rather than doing face-to-face meetings. I know, especially in this time of coronavirus, face-to-face meetings are very much out of the question at the moment, and so verifying ID and also putting a face to a name is fortunately made possible through communication platforms such as WhatsApp, WeChat, Messenger, FaceTime, Google Meet. These types of backups that brokers may not initially think are necessary for their job are now becoming necessary. Now that coronavirus has caught us slightly off guard, with how we run our businesses. I think that this conversation of diversifying our methods of business has definitely come straight to the forefront, and that it is a necessary cost to embrace rather than forego. And it is important to see that financial technology should be considered an important investment in sustaining your business rather than a recurring expense that doesn't generate any benefits. And I think on that note, we'll end it there. This has been another episode of the Cost of Carry podcast. Thank you all for tuning in, and I look forward to speaking to you next week.